Two journalists working for Wall Street Journal took to Reddit to do an Ask Me Anything about Silicon Valley Bank, likely to engage potential readers and to research what people are curious about. I'm Zach with The Money Channel, and I think it's best we dive into it. Silicon Valley Bank collapsed on Friday, becoming the second biggest bank failure in US history in terms of assets. On Sunday, regulators also took control of Signature Bank and rolled out emergency measures to prevent a banking crisis and guarantee depositors access to their money. This means businesses with big deposits stuck at the banks will get their money out, though likely not soon. This meltdown has exposed a new set of vulnerabilities for the financial system, and the rest of the banking system is on edge. Why did SVB choose not to de-risk when the Fed was telegraphing rate increases, which meant their bonds, and thus a significant portion of their holdings, would lose value? Our recent reporting noted that SVB leadership stayed optimistic about the markets calming down all the way up to the end, betting that interest rates would fall and homing in on the boom and bust tech industry. Beyond that, I would note that while SVB may have been particularly exposed to rising rates, many banks are sitting on large unrealized losses on their balance sheet. FDIC put those losses at $620 billion at the end of last year. The role of a bank, generally speaking, is to borrow short-term and lend long-term. And this isn't necessarily a concern unless that short-term borrowing deposits flee in a rush and you are stuck with long-term assets. Yes, but many banks don't have 90% uninsured deposits and aren't narrowly focused on high-risk financing to withdrawal-heavy VC clients during a recession. SVB's business model was absolutely nothing like most banks. That's why everyone was shocked by how incompetent their risk management was. Moody's didn't downgrade them for funsies. It's not a fluke that they couldn't raise the capital. There's no probably put too much in or didn't hedge or exit the position. They put too much in and did not hedge or exit. It was complete idiocy, and nobody competent wanted to take the risk to bail them out. SVB was compliant with government regulations and solvent enough to return all deposits even without the FDIC. False, they are billions of dollars short. I don't know where you're getting your news, but your theory is completely counterfactual here. How big is the risk of contagion? Is a bailout of depositors possible, likely without taxpayer money? The question of contagion is a really important one. The measures the government took on Sunday night are very significant. They are clearly hoping that they will stem depositor panic. On Monday, some regional bank stocks still posted huge declines, but today things seem to have calmed down somewhat. The government says that it will be able to pay back uninsured deposits without tapping taxpayer money. The money will come from the Deposit Insurance Fund, which is funded by banks. The total amount in the deposit fund, $128 billion at the time of 2022, appears to be slightly less than SVB's total uninsured deposits, $151 billion. How do you think they will make up the difference? Does the insurance premium work the same way as insurance policies we're used to? Will all banks see an increase in FDIC premium fees as a result? If another bank fails, will they be able to back uninsured depositors again? They will barely need to tap into the deposit fund. SVB is selling assets that will cover 90 to 95% of the uninsured depositors. Feds will only be on the hook for $10 to $15 billion at worst, which is easily covered by the deposit fund. The government said on Sunday that any losses to the fund would be covered by a special assessment on banks, so you're right to think that banks will have to pay into the FDIC to cover this. The US House Financial Services Commission has scheduled a hearing on March 29 to investigate the collapse of two major banks, and representatives from the Federal Deposit Insurance Corporation and Federal Reserve will be testifying. Chair Patrick McHenry and Ranking Member Maxine Walters announced the FDIC Chair Martin Gruenberg and Fed Vice Chair for Supervision Michael Barr are expected to provide testimony in response to the failures of SVB and Signature Bank. A statement reads, "The House Financial Services Committee is committed to getting to the bottom of the failures of SVB and Signature Bank. This hearing will allow us to begin to understand why and how these banks failed. As chairman and ranking member, we take our oversight duties seriously. We are working around the clock to deliver answers to the American people in order to protect depositors, promote the safety and soundness of Americans' banks, and strengthen our financial system. We will conduct this hearing without fear or favor to get the answers the American people deserve." Should SVB really have been considered systemically important? Ben replied, "SVB isn't technically defined as a systemically important bank, but some would make the argument that allowing the bank to fail without making depositors whole is a systemic risk because it would lead to a run on other banks and cause the crisis to spiral. That piece of it perhaps gets at why regulators made a systemic risk exception for the banks that failed. Can you comment about Kessler's allegation in a Wall Street Journal opinion piece that SVB's diversity efforts contributed to their management failures? I quote, "I'm not saying 12 white men would have avoided this mess, but the company may have been distracted by diversity demands." Maddie from the Wall Street Journal Reddit team responded, "We work for Wall Street Journal Newsroom, which is separate from opinion. So does it irk you professionally that its editorial board seems to be committed to the singular focused vision of eroding the US tax base and politically supporting whoever seems likely to make this possible, no matter how vile? They're not going to make disparaging comments about their colleagues, regardless of how obviously terrible their behavior is. Why did so many startups have their funds there? Were VCs requiring them to? SVB was around basically as long as Silicon Valley, so it was very much embedded in the startup industry. Leadership long prided itself on understanding the startup VC world and being able to serve it better both on the lending side and then the deposit side. They also often asked those companies to do their banking almost exclusively with SVB. What are some companies we can expect to be directly affected by this collapse? It's hard to make a comprehensive list because the implications are probably going to play out over a very long time. But to start, SVB banked a technology-focused customer base. Venture capital funds, startups, even big tech companies are trying to figure out what to do with deposits and loans held at the defunct bank. More broadly, bank failures can lead to tightening in credit, which means companies and individuals could have a harder time borrowing down the line. And then many think regulators will revisit some of the regulators that apply to banks with $250 billion in assets or less. If that led to new regulations, the whole sector would be impacted. How can people gauge the risk at their own banks? What are the warning signs? I think a big takeaway for so many bank customers is that FDIC insurance limits are important. Anything over $250,000 for individual account or $500,000 for a joint account is not insured by the FDIC and therefore subject to the risk of the bank. Is SVB likely to be bought out by another company, and if so, what is the profile of the buyer? This is an open question. Our Wall Street Journal colleague Andrew Ackerman reported yesterday that the FDIC is planning another auction for SVB and noted that now the firm has been declared a systemic risk. Regulators can offer deal sweeteners such as loss-sharing agreements. For now though, SVB is operational in its new form. It seems like this collapse wouldn't have happened if depositors didn't start pulling their funds out. What was the initial reason for depositors taking their money out of the bank? Was there news that broke prior to it becoming a national story? I was watching the stock drop on Thursday morning throughout the day, just wondering when this all started and how those depositors knew something bad was about to happen. SVB's business had clearly taken a hit from rising interests in the last few months. We did a story back on this in November 2022, but it seemed relatively manageable. On late Wednesday last week, that suddenly changed when the bank disclosed that deposit declines prompted it to sell securities for a large loss. The following day, as you saw, the bank's stock nosedived. Spooked customers saw the disclosures and stock decline and withdraw a whopping $42 billion, which forced regulators to close the bank on Friday. Is there anything to the rumor that SVB could have paid 2 basis points for additional deposit insurance but elected not to? Also, is there anything to the rumor that SVB went a significant period of time, multiple years, without a chief risk officer? We've reported that SVB dropped a hedge against rising rates in 2022 from our story. Throughout 2022, it decreased its hedge to the point where just $563 million of its $26 billion in available for sale securities had interest rate hedges as of year end, down from $15.3 billion a year later. The bank didn't report any swaps on its other $91 billion buckets of bonds, so-called held to maturity securities. We've also reported that the company did not have a chief risk officer for a period. The bank was without a risk officer for the majority of last year, and this departure was first disclosed by the bank last week. Since the formation of the FDIC, has an uninsured depositor ever lost funds due to a bank failure? Yes, depositors have taken losses in the past, notably at IndyMac during the last financial crisis, but it's noteworthy that such a large share of SVB's depositors, nearly all, were uninsured.